So we move to chapter 13, time series analysis. This is quite an interesting chapter because we've talked a little bit about forecasting. We've also talked a little bit about the difficulties for management accountants to really forecast and indeed budget numbers, budget figures into the future. So this area of time series analysis provides us with an opportunity to be a little bit more secure about future numbers. Let's see what we mean by that. There's four main components in time series analysis. Now, please note, I've seen questions within the OT exam, and you will see too, just based on what the four components are. Literally, we're getting marks just for that. So let's concentrate and focus here. The trend. What do we mean by that? Well, the underlying long-term movement in values over time. The simplest way of thinking about that is let's look back on sales over the course of the last 12 months. Perhaps there's an underlying trend. If we look even further back, let's say 5 years, perhaps there's even more of a trend. So all that we're saying is long-term movement. In terms of seasonal variation, we're talking about short-term fluctuations. You might even call them short-term trends. So over the course of a few months. And note, they are what's known as seasonal. So it's very likely, let's say year on year, let's talk about something really, really simple, like the purchase of ice cream. When the weather gets hot in the summer, there will be a short-term fluctuation in sales values of ice creams over the course of the summer period. And that will be seasonal. Therefore, it will invariably happen each year. In terms of cyclical variation, note, we're talking about medium-term changes resulting in factors that, or from factors that repeat in cycles. Now again, a simple example of that, although sort of more macro, would probably be the economy. The economy can be cyclical, boom, bust, buy, sell, recessions, depressions, etc., etc. Now note, medium term. Last area for us is completely random. So we're talking about something that is not part of a pattern, unlike seasonal, cyclical, obviously the trend overall, and very, very difficult to predict. Okay, so a good opening for us, let's remember those four main areas. Now in terms of looking at variations of the graph, I'm hoping that you can see that okay. I've just taken this directly from the ACCA hub. Pretty straightforward. We're talking about dollars on the y-axis. We're talking about time increasing on the x-axis. And you'll see that we have trend and indeed data line. So looking at the seasonal variation, you can see, broadly speaking, it's reasonably sort of predictable. And you can see the data line moving from this point through to the end point. So you get the idea for, obviously, the seasonal and indeed the trend over time. Pretty straightforward. Let's move from there in terms of predicting future values. Remember, we said that on occasion, perhaps management accountants would use time series analysis in order to be able to perhaps prepare a budget or prepare a forecast. So really, we can use one of two models, okay? And we'll see the formulas again. I've taken this directly from the study hub. You'll see we're either talking additive, or, as we said here, multiplicative, okay? Now, the data point, let's say the point at which we're trying to establish is y, okay? And you can see very, very clearly, based on what we said up top, that we're talking about trend plus seasonal variation, plus cyclical variation, plus random variation, okay? And we can do it one or two ways. Absolutely fine for us to choose, depending upon the question. Now note, as it says below, if we're looking purely at short-term forecasting, so, let's say 3 to 6 months or thereabouts, then what we'd be inclined to do is to take out the cyclical and the random variation from the equations. Why? Because the possibility of them impacting is less, particularly from a cyclical perspective. So you can see the formulas are exactly the same, just with the C and the R excluded. So let's be careful. Let's read the questions carefully. For me, although these formulas, this area, time series analysis may sound complicated, may sound a little bit crazy, actually, when you see the questions, they're very, very manageable. So again, as I've said, this is one of the areas that I would see us having go-to questions. In other words, questions that are fairly straightforward that we want to be getting right, unlike perhaps some of the other areas of the NA syllabus, which are certainly more difficult. So those are the formulas, and indeed, moving on from there, when we think about approach. So what is the approach using time series analysis based on what we know? Well, first things first, identify the trend of a time series using either moving averages, more of that in a moment, or linear regression, okay? Second thing, forecast the time series trend into the future based on that trend. Third point, identify the seasonal variations, which we'll call the trend to alter, obviously, from its linear function. We saw that in the diagram above. And then 4, adjust the trend by the estimated seasonal variations to prepare budget forecasts. So in essence, what we've got here as a sort of a 4-step approach to how a management accountant might forecast forward in terms of, let's say, a master budget of some kind. Now, in terms of this next area, determining the trend, we talked about moving averages, and we talked about, I guess, the definition of the trend. Really what we're talking about is a smoothed out time series line. In other words, the trend line indicates the general direction. You saw from the diagram above, we went from the left to the right. With a data line with minimal fluctuation. So in essence, really that's what we're talking about. That's the trend going from left to right along that straight line. Now, in terms of establishing it, several ways to do it, okay? Of which moving averages is just one. We could use regression analysis. We could draw the line, literally draw the line, or we could use a method called moving averages. And I would say in the exam, probably the third, moving averages, is probably the one that's favored. So let's talk about moving averages. What do we mean by that? Well, we're talking about calculation of an average of a set of consecutive periods, and in effect, by removing the seasonal variations to estimate the trend. So we're looking at a number of periods, let's say 5, and we're talking about a method really of removing any variation that is seasonal. Moving from there, an average periodic increase, we're talking about taking the difference here between the earliest and latest values and dividing by the number of sets, assuming the trend is consistent. So when we think about an average, we generally think, let's say, about 2 numbers, don't we? And in effect, adding them together and then dividing by 2. So really, what we're talking about here when we say, an average periodic increase, what is the average? I guess it's the simplest form of increase, because all that we do is take the 2 values, the earliest, then the latest, and divided by the number of periods, assuming that the trend is constant, okay? And we'll see here in terms of the formula, simple as that, trend the latest value minus trend the earliest value, note, divided by number of periods, okay? Now, in terms of regression coefficients to calculate the trend, when the linear function of a trend line has been derived, when it's been worked out by using regression analysis, It can also be used, we're talking about formulas here, equations, etc. It can also be used to obviously forecast any number, cost, revenues, etc. Okay? So, in terms of the seasonal variation in a time series analysis, then first things first, let's just remind ourselves, what do we mean by seasonal variation? We're talking about regularly occurring fluctuations on the trend line for a time series. You recall I mentioned ice creams, summertime. It happens every summer. Now, in terms of the formulas, you'll recall we looked at the additive model and we looked at the multiplicative model. So I refer you back to section 1 in that case. So in terms of the steps, what would we use? Well, first off, calculate the trend. Secondly, calculate the variation, if any, for each season. And then average the variation for each season and then normalize. Again, much of this area is better done once we have done some questions. I'm hoping that you're going to bust into the OT question section of the course very soon. In terms of budget forecasts, I've mentioned them from the off, but certainly, information about trends and seasonal analysis can be used to make budget forecasts, So when we think about regression coefficients, using forecast trends, or perhaps in adjusting forecast trend values by seasonal variations could also be used. So a number of different uses of this particular area for budgeting, and we know how hard budgeting is. We know how hard forecasting is. So these techniques are useful to us. Now, useful in many, many senses. Clearly, forecasts, if we think there's some sort of straight line, some sort of linear relationship assumed to exist, and we have some detail, let's say, maybe about seasonal variations. In essence, point number 2, if we think that there's a fairly strong sort of relationship, it should be fairly reliable. We can use this area, to our advantage. But all is not good in one sense, because, we have to, in one sense, assume some sort of relationship or straight line linear function relationship. But, in reality, it may not be the case. And in addition to that, probably more importantly, remember, we're talking about, let's say, for example, budgeting. There's an assumption here that what has happened in the past, because everything we're talking about here is in the past, the seasonal, random, the trend, cyclical, it's all in the past. We're assuming that that's going to happen in the future. It may not be the case. It may not be the case. So certainly some upsides, but also some downsides. Any form of forecasting has a pothole of disadvantages. Okay, so that concludes time series analysis, chapter 13. I hope that you found that helpful. I think this certainly is a chapter where I favor, doing questions at the earliest point rather than dealing with the theory. There are several chapters like that. I've pointed them out within the course. This area, in my experience with students, will tend to drop. You'll tend to get it, not so much by reading the study hub, but by failing the questions over and over again and learning from experience. I hope that made sense. I hope that your studies are going well. Many thanks for listening.